Good morning, guys, and welcome to the Camp Financial Stock Market Update. Today is Tuesday, March 21st. It's been a little while since we've done a video, so we wanted to do a kind of quick rundown through the positions in the portfolios, as well as we'll take a look over the last week or so in the S&P 500 heat map. And I wanted to talk about a few specific stocks that have kind of been on my mind, or kind of percolating ideas. One of them actually just came to me yesterday from somebody else's video, but some other stock ideas that I think could be interesting here in the next few months and going forward. So with that, let's get into it. First, we'll go through our portfolio. We did sell out of American Airlines on March 15th. So we liquidated that position at a little over 3%, about a 3.25% total gain on American Airlines. The stock, we got in back in October at 38.85, let it run, and then just recently it's really taken a big hit. It's kind of turned back around and run all the way back down. We ended up getting out of that a little over $40 a share. Actually, it's almost 41 bucks a share. So we're now out of American Airlines, like I said, at about a 3.25% total gain from the time we held. So I'm happy with that. We always like to, we always would love it to be a little bit more, but nothing terrible there either. It's not like we got killed. So looking through the rest of the technical portfolio, so we've really only got one that's within 10% of being stopped out, and that's ConocoPhillips. Everything else is still ripping, roaring pretty well. Bank of America is still the best trade that we've got in there. Even with its current retracement a little bit, we're still up about 53% since we originally got into it. So that was just in September as well. Ormat Technologies, we're going on just about a year that we've been holding that. It's up about 38%. Blue Cap Reinsurance Holdings, we've been in that for just about 2 years, and we're up about 25% on that one. And then the worst one that we're still holding on to is GE. We've been in that for about a year and a half, about 18 months, and it's up just 2.25%, and it's pretty much been flat, collecting the dividend and just letting the stock kind of do what it's doing. So let's take a look at our other portfolios here. Our Quanta Funda Techno, one of the stocks in that AAON, not AON, just ticker symbol AAON. So it is just about to our profit point. We needed to tick up about another $1 per share, and then we'll be liquidating that one. So, or liquidating our initial investment in that one. Our undervalued purchases, they're all running pretty well. They're still way above their stop prices. Unum Group is up about almost 46% in just under a year. Marriott Vacations Worldwide is up 43% in just under a year, and Exelon is up about 10% in just under a year. The one we liquidated in that system, Sunoco, if you remember, on that one we liquidated and ended up with about a 25% loss on that specific stock. So with those, all those other ones performing well, we'll go ahead and jump into what the Undervalued Systems done since we put it into since we started using it. So in just under a year, again, we just started this back in April of 2015 or 2016, and so in just under 2 years or under a year, I don't know why I keep wanting to think it's 2 years. We're up 23.34% on that portfolio versus the S&P at 12.9, the Dow at 15.53, and the Nasdaq at 19.5. So it's obviously running pretty well. This month it's having a rough month, but it's all right. It's definitely lagging the indexes this month. Get into our technical system so far this year. The technicals is actually down about 1.5% versus the S&P that's up 6. The undervalued system is up 8.4% this year, again versus the S&P at 6, the Dow at 5.78, and the Nasdaq at 9.63. And our oldest system, the Quanta Funda Techna system, let me get the numbers pulled up here so we can see what it's done year to date. Year to date it's up 9.72%, again versus the other indexes that we've already mentioned. So it's actually leading all indexes right now, and that's why we use at least right now where we're at 3. We're looking at adding a few more systems, because that way when you're not reliant on everything zigging in the same direction at the same time. If you're working on a bunch of different timelines or a bunch of different investment styles, sometimes one style is going to perform really well while the other ones don't move that much, and sometimes the other system is going to, the one that was lagging while one was running is going to take off while the other one starts to slow down. So that's why we use different investing styles all within the same portfolio, so that overall we should be getting a nice solid return. So all right, now we'll pull into the last week. So Amgen is down big, as well as Biogen, the biotech sector. I mean, Gilead's up and Celgene's up, but for the most part the biotech sector is all pretty much down. Baker Hughes up 6.5% in the oil and gas equipment services. It's pretty much a mixed bag there. There's a few of them down and a couple of them that are basically flat. Specialty chemicals, that's actually one where every one of them is up right now. Let's see which one this is. International Flavors and Fragrances up 7%. Definitely performed well over the last week. Oracle up about 6.25%. Leading the application software. Adobe's not too far behind at up 3.7. Let's go down to the textile, apparel, footwear. Nike, I see Nike up 3.5%. Coach is up about 0.6%. And actually Fossil Watch is up over the last week about 0.73%. So they may be finally starting to find a bottom to the pain that they've been feeling recently. The auto manufacturers are down. All the financials are down. Looks like pretty much all the banks are down. A little more mixed bag in the property and casualty insurers. Nothing big and bright to mention. It doesn't look like. Capital One is down about 5.5%. In that same sector, though, you have Western Union up 4.25%. So definitely some disparity in the credit services. The real estate investment trusts are continuing to run, and that's really driven to still a big play for yield. Yeah, and then now I'm in the industrial REITs, and those are also up, pretty significantly. So, all right, so we were just talking about yield. Let me go back here, and I'm going to mention 3 stocks. Hopefully we can get through them fairly quickly. One, watched a video on yesterday. Guys expecting, so we're going to talk about Kohl's first. So guys expecting this thing to pull back to about 35 bucks a share. Right now it's trading at 38.55, and I mean, I could see that. If you look back at their chart, it looks like $35 is kind of the next stopping point once it dropped solidly through that $40 line. So I can see that on the chart anyways. So if it drops to 35 bucks a share, now we're talking about a stock that yields almost 6%. We're talking about a stock that has roughly $6 in free cash flow, and a $2 dividend. So only 33% of its cash flow is required to pay the dividend. They've got no problem continuing to pay that $2.05 dividend. Now, they are starting to, last year they did have a retracement of about 2.5% on their earnings. So if they would lose again another 2 to 3%, now the free cash flow is coming down, the earnings is coming down. But we're talking about a stock that trades at about a 12 times their earnings multiple. So they're not highly valued. So we shouldn't be concerned about them tanking way off. So I would like Kohl's at $35. That's definitely one where you can put in a sell a put option at 35 bucks. I think I looked at the June put option. No, I was looking at Apple yesterday. But Kohl's is one that you can put in a put option for 35 bucks. And if you get stuck with the stock, you got in at $35 a share, and you're going to get almost a 6% dividend yield. And then you just keep an eye on the company to make sure that they're going to continue to be able to pay that dividend. But right now, I don't have any concerns about them continuing to pay a $2 dividend on $6 in cash flow, with earnings of about $3.20 a share. I mean, they're paying almost all their earnings out, but they're in a good position, and they've been starting to look at closing stores. So they know where, at least it appears they know where they have some issues. Next one, also in the store market, is Target. Target's been absolutely obliterated this year. It's down from about $73 a share to $54 a share. Here again, we're talking about a stock that pays 4.5% dividend. It's $2. So $2.40 goes to a dividend. They have roughly a little less than $5 a share. So their dividend, I'm a little more concerned about. I think that they'll continue to pay it. They may not increase it, but $2.40 a share on the dividend is going to cause them a little more pain. So like I said, I don't see them lowering it, but they may. And if they do, watch out, because Target will drop big if they lower that dividend. The $2.40 that you can make on it, here again, this might be another one where maybe $50 is where you're willing to enter. So sell a put option at $50, and that way, if the dividend does get dropped, you're gonna get in at 50 bucks a share, and you're still going to get a pretty decent yield. And that's how I played SeaWorld last year, expecting the pain. I sold a put at 14 bucks. They lowered their dividend. The stock dropped to 12 something, so I had a put on me. It ended up being about $13.35 a share. It dropped to about $12.50, and then all of a sudden SeaWorld turned around and ran right back up to 18, 19 bucks a share, and I got out. It made a nice profit. So, you know, you've got the potential to do that with Target as well. The other one I was looking at is I like Kroger at $30 a share. Kroger trading under 30 bucks a share. You've got a company, again, I like to look at their cash, the free cash flow, so they don't have the cash flow to continue to pay that dividend. Kroger's in a tough spot, but I like Kroger at $30 a share because I know the company and I know what they can do. So that's it for today, guys. Take care. We will see you next time.